Now we'll discuss about investing activities. In the last segment, you came to know about operating activities. Now this is the turn of investing activities. Actually, in a business, if any long-term asset is sold or purchased, that is called investing activities. For example, if furniture, building, land, or any other asset is purchased, that will be called investing activity. And if the company buys or sells any long-term asset, that will also be called investing activities. Be careful. If the company is going to sell or purchase any marketable security or marketable investment, that won't be in the category of this category. I mean to say investing activity. The reason being, marketable securities or marketable investments are just like cash because they are taken as cash equivalent. So be careful. In investing activities, you won't include sale and purchase of marketable securities and investments. Okay, let me take one example. Suppose on 1st April 2010, A started business with cash rupees 10,000. During the year, he purchased goods rupees 5,000 and he sold goods 9,000, expenses 1,000, furniture 2,000. And prepare cash flow statement as on 31st March 2011. To prepare the cash flow statement for the year ending 31st March 2011, we need the balance sheet. And to reach the balance sheet, first of all, we'll have to make cash book, then income statement. Only after that, we can prepare the balance sheet. If we have got the closing balance sheet as well as opening balance sheet, only in that situation, we can prepare cash flow statement. So first of all, I'm going to prepare cash book. On debit side, to capital, 10,000 rupees because it's a fresh capital. To sales, 9,000 rupees. By purchases, 5,000. By expenses, 1,000. By furniture, 2,000. And by balance CD, 11,000 rupees. So this is just like the previous question, but there is one additional information that furniture has been purchased for rupees 2,000. Now prepare income statement. So be careful in this question, all transactions are cash transactions. So on the debit side, opening stock 0, to purchases 5,000, on credit side by sales 9,000, on debit side to expenses 1,000, on credit side by incomes 0, and on debit side to net profit 3,000 rupees. Total 9,000 rupees on both sides. Now prepare the balance sheet. Liability side, capital 10,000 plus 3, 13,000. 13,000 will be written in the outer column and 10,000 plus 3 will be written in the inner column because the opening capital was 10,000 and during the year this firm made profit of rupees 3,000. And on asset side, cash 11,000 rupees and furniture 2,000 rupees. Total 13,000 rupees. And you are asked to prepare cash flow statement. First of all, if you look at the cash book, you will find two types of activities. Some transactions belong to operating activities. Operating activities means purchases and sales, expenses and incomes. Only 4 things are in the category of operating activities. So, cash generated through sales was 9,000 and cash lost, that was due to purchases 5,000 and expenses 1,000. Total 6,000. So in this way, the net inflow from operating activities was 3,000 rupees. if there is net inflow from the operating activities, that will be called cash from operation. So in this form, the cash from operation is rupees 3,000. If the firm has lost cash due to operating activities, then it will be called cash lost in operation. But this is a positive figure, so we will call it cash from operation. One thing more, your net profit is also rupees 3,000 and your cash from operation is the same amount. I have already explained you, if there are all cash transactions and there is no closing stock, net profit is always equal to cash from operation. I mean to say net inflow of cash from operating activities. Anyhow, now I'm going to start cash flow statement. Draw a T-shape figure. When the same you draw in the cash book. So you find two sides, left side and right hand side. So on left hand side, create a cash column, and in the same way on right hand side, create a cash column. So particulars, amount, particulars, amount. So there are 4 columns just like cash book. So on left hand side, you can't call it debit side and credit side because debit and credit sides are always in the cash book, not in cash flow statement. So opening cash, rupees 10,000, because in the beginning of the year, the cash was rupees 10,000. And now write down cash from operation, 3,000 rupees. And on right hand side, furniture purchased, 2,000 rupees. And the closing cash, 11,000 rupees. And the total on both sides, 13,000 rupees. So this is the cash flow statement. So this cash flow statement is clearly showing that there was inflow of cash from operating activities, that was 3,000, and cash lost in investing activity was rupees 2,000. That's why opening cash was 10,000 and closing cash is 11,000 rupees. There is net inflow of cash is 1,000. So on one side, we have generated cash from operation 3,000, and on another side, we have lost cash in investing activities, that is rupees 2,000. So be careful. In cash flow statement, investing activities are shown individually, means each and every item, but operating activities are not shown individually. The net result of operating activity is called cash from operation or cash lost in operation. If you find any cash from operation, means positive figure, then it will be written on left hand side, I mean to say the inflow side. And if there is cash lost in operation, then you will have to write down on outflow side, I mean to say payment side. We don't call it payment, we call it outflows.